This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Okay, we're going to look at value at risk, and I hope you've got in front of you the short question that goes with this lecture. This question, incidentally, is very, very much like part of a recent exam question. It was only part of a question, it was only actually 4 marks. It could be a few more, but once you've got the hang of it, it's actually very, very easy marks. But have a look with me. It says, James has estimated an annual standard deviation of 750,000 on one of his projects based on a normal distribution of returns. Now, I'll explain what we mean by that in one moment. But it says the average annual return is 2.4 million. We're asked to estimate the value at risk at a 95% confidence level for 1 year. And then afterwards, second bit, also over the project's life of 6 years. But let's forget that for the moment. Now let me explain what's going on. Now ultimately you can just learn a rule. But I think it's important you see why the rule is what it is. If for no other reason, then obviously there can be little bits of writing about it. But the point is, it tells us that this project gives an average return per year of 2.4 million. And the fact that it's an average means, it may be based on an estimate, it means that of course the return might be higher, it might be lower. And if the return's higher, then great, no problem at all. But where there is a problem, potentially, is of course if the return is lower. The lower the return, I think clearly, the less happy we're going to be. It says these returns are normally distributed, and what that means is that if we plotted the possible returns on a graph, that it looks something like this. Here's the return. The average return, the most likely, is 2.4 million. But there's a probability of the return being anything. It may be 3 million, 4 million, 5 million. It may be 2 million, 1 million. It may be higher, may be lower. But the reason the curve falls is it gets less and less likely as you get higher and higher, and similarly as you get lower and lower. We assume it's symmetrical, and so there's a 50% chance or a 0.5% chance that the return will be below 2.4 million, and equally a 50% or 0.5 probability of it being higher than 2.4 million. Well, again, the actual return may turn out to be higher, it may turn out to be lower, but when it says we've got a 95% confidence level, what it means is, remember, we're only worried if the return is lower. Well, we're going to set what you might call a bottom limit, such that the chance of it being above that limit, a 95% or 0.95, the chance of it being below that limit, and therefore 5% or 0.05. Now, we're going to calculate what that limit is, but just suppose, and I'm making up a figure, suppose it was 500,000, just suppose. We've already said the actual return could be anything, higher or lower, but we want to fix that limit such that the chance of it being higher than that limit, a 95% 0.95, the chance of it being below that limit, there's only a 5% chance of it being below 500,000, or 0.05. Now, the 0.5 million I invented. That's what we've got to calculate. Is it 0.5? Is it 0.4 million? What is it? But that's what we're after, effectively. Setting this limit such that the chance of the actual return being below the limit is 5%, or of it being above the limit is 95%. And we are able to do it because with a normal distribution, what we're able to work out is how many standard deviations that distance is. The distance between the average of 2.4 million and this limit that we're after. We know what we know what the probability is of being between the average and the limit. Think about it. We've already said there's a 0.5 probability, 50% of being below the average. We're setting the limit such that there's a 0.05 probability, or 5% of being below it. So we want the probability of being in this range to be 45%, or 0.45. Now you should actually be aware, if you've looked at option pricing, you should be aware that we can use normal distribution tables. And for any number of standard deviations, we can work out the probability. And that's what we're going to do here, but as you're about to see, we effectively, well not effectively, we actually do use the normal distribution tables backwards. And so, let me call up the normal distribution tables and be patient with me for a moment. Here we are. These are the tables you get given in the exam. And you should know how to use them already, but in case not, what we're able to look up is for any number of standard deviations away from the average, what the probability is. So for instance, if I wanted to know the probability of being 1.12 standard deviations away from the average, we say, well, 1.1, we look at that row, and as you move along, this column is 1.10, this column 1.11, here 1.12. So it's 1.1, 1.12, and that figure there is the probability. There's a 0.3686 probability of being 1.12 deviations from the average. Well, we're going to use it backwards because we said a moment ago that to fix our cutoff at 95%, we want the probability of being that far away from the average to be 0.45, 45%. So we look at all the possible answers from the table. Look at all the answers and see how many deviations gives us an answer of 0.45. And if you look down, where are we? Blah, 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 blah. 0.4. Here we are. There's 0.4595. Here's 0.450505. And so, surely to get an answer of 0.45, it's more or less halfway between those two. And how many standard deviations is that? Well, it's the 1.6 row, and it's halfway between 0.04 and 05. So to get that answer is approximately 1.6. That's the row we're on. Halfway between 4 and 5, so 645. I said approximately because in fact it's not precisely linear, so it's not exactly 1.645, but it's about that. But it means that if the distance from the average is 1.645 standard deviations, the probability, the chance, is 0.45, 45%. So let's go back to where we were. Now here you're going to have to be patient with me a moment. There we are. Looks a bit messy. But to get an answer of 45%, 0.45, it's 1.645 standard deviations. And now it's easy, because the question tells us what the standard deviation is. It's 750,000. which comes to how much? $1.233750 million. That's that distance there is 1.2 million. And so that's how much we're at risk. Remember, we think on average it'll be 2.4 million. It might be lower. We can afford it to be up to that much lower at 95% confidence. There's a 5% chance that it'll be more than that much lower. Or if you prefer, the cut-off point, the average, remember, is 2.4 million. We can afford to be that much lower, the distance away, 1.233750. And so a cut-off of 1,166,250. And if you've understood me, you should be happy that there's a 95% chance that the return will be higher than that figure. There's only a 5% chance that the return will be lower than that figure. So it can happen, but we've set our cutoff. We decided on 95% because perhaps we feel that the chances of it being that low are almost impossible. We're prepared to take the risk. We'll base any decisions on the fact that we're confident that it'll be more than 1.166 million. But we're never certain, but we're 95% sure that it will be. Okay, we did 95% confidence. In fact, you can choose any level of confidence. In the exam, there's almost no doubt it will either be 95%, which you just saw is 1.645 standard deviations, or alternatively 99%. And say in the exam, it'll almost certainly be one of those two. And although I'll write down the answer for 99%, it'd be a good idea if you just pause this lecture and have a go yourself. That's why I'm pausing. But anyway, now I'll carry on. Think about the graph again. This time, if there's a 99% chance of being above the limit, or a 1% chance of being below. Again, because 50% above, so 49% between the average and the cutoff. So again, how many standard deviations? We want an answer of 49%. And so look at the tables. 49% is 0.49. And so where are we? To get an answer of 0.49, there we are. It's almost exact. Sorry, I've slightly rubbed it out, but 0.4901 is near enough. And how many deviations is it? 2.3. And for the second decimal place, which column is it? 3. And so it's 2.33 standard deviations. And so going back to where we were, if it's 99%, exactly the same sort of arithmetic, but the distance away from the average will be 2.33 standard deviations. I'm not going to do the numbers, but if they did want an actual figure on it, then here with a deviation of 750,000, the distance would be 2.33 times 750,000. So although I said at the beginning, I think it's important that you basically understand what these figures are and where they came from. If you want, learn those two. As I said, although in theory you could choose anything, you try it yourself for 98%, 90% and so on. It's the same logic. There's virtually no doubt in the exam, if it's asked, it will either be 95% confident, so 5% chance of being below the limit, or 99% confidence, a 1% chance of being below. Sorry, that took me a while to explain, obviously, but once you've got the idea, the arithmetic itself is terribly quick. However, this question did ask for two things. If you look at the actual, the last sentence, it says estimate the value of risk for 1 year, and that's what we've done. The average for 1 year, 2.4 million. The deviation for 1 year, 3/4 of a million. And so the value at risk, where were we? 1.2. The cutoff, 1.166. But it also asks us to do it for the project's life of here 6 years. Well, it's exactly the same logic, so I'm not going to draw the picture again, but we assume it's normally distributed. The average, it's 2.4 a year. Well, I'll write down in a minute, but over 6 years, it'll be 6 times that. And for 95% confidence level, 1.645 standard deviations away. However, there's one little trick here, one more thing to learn. First of all, over 6 years, the average is no problem. Surely, if on average you're getting a return of 2.4 million a year, the average return over 6 years will be 6 times 2.4 million, which is, I think, 14.4 million. I could check and then nobody complains later. Yeah, 14.4. So there's our average over 6 years, and the story's the same as before. The actual return over the 6 years may be higher, may be lower. We also need the standard deviation. Well, here, one extra little bit. Again, if you've worked through other chapters, portfolio theory, for example, I think you'll know this. But with standard deviations, you can't simply say the standard deviation over 6 years is 6 times the standard deviation over 1 year. It doesn't work like that. We have to square it. The standard deviation squared, this is the 6-year deviation, is going to be 6 times the standard deviation squared, the 1-year deviation. You don't need to know the word, but in fact, the standard deviation squared is called the variance. Now, I think it's extremely unlikely you'll be tested on it, but if you ever see mention of variance, it is the square of the standard deviation. But again, you can't simply add standard deviations together, it's the variances. So the 6-yearly variance, or standard deviation squared, is 6 times the 1-yearly variance, or the standard deviation squared. And I would learn that. It was in the exam, it could be again. I think in the exam it was over 5 years, no problem. The total deviation squared is 5 times the 1-year deviation squared. Which is what? Standard deviation squared I beg your pardon, I've written it. It's 6 times standard deviation squared. The standard deviation, therefore, over 6 years is going to be the square root of that. Which is, think about it, I mean, you can't put the whole thing in your calculator, but if you think about it, It's the square root of 6 times the square root of that. The square root of 6 times the square root of the standard deviation squared. Which now is easy, surely. It means a 6-year deviation. The 1-year deviation we were given was 750,000. Multiplied by the square root of 6. I hope this is right. I get 1837117. So there's the standard deviation for 6 years. And now we carry on as normal. Over the 6 years, standard deviation is that. I wrote down earlier that the average, or the mean, was 14.4 million. And at 95% confidence, the value at risk, the difference between the average and the cutoff, is going to be 1.645. I went through why it is earlier, times the standard deviation, which is 30222057, which means the cutoff point, look back to what I did earlier, but we know the average is 14.4. We know we can be up to 3 million below, which is I think 11,377,943. So there's the cutoff, the average 14.4, the cutoff 11.377, 11.4. There's a 5% chance of it falling below 11.4 million over the 6 years. Or there's a 95% chance, with 95% confident, it'll be higher than that.